Hey, option traders. For today's strategy, we're going to take a look at a long call option in Goldman Sachs, which is looking very strong. Yesterday, call option volume for the stock outpaced put volume by a ratio of 2 to 1, which could be seen as a bullish sign. The stock is rated number 2 in its industry group with a composite rating of 95, which is very good. Shares also recently found support at the rising 50-day line. So traders who think the rally in Goldman Sachs will continue higher can look at buying call options. Long call options can be a great way to gain exposure to a stock without risking as much capital as you would if you just bought the stock outright. One of the benefits of call options is that they provide leverage. So assuming an investor wanted to buy 100 shares of Goldman Sachs, they'd have to invest around $37,000 at the current price. So instead, you could gain a similar exposure using a fraction of the capital by buying call options. One option gives the investor exposure to 100 shares. So let's take a look at Goldman Sachs and set up this trade together. So here we are on my trading dashboard, and we're going to go ahead and set up this trade. First, you're going to want to type in GS, which is the ticker symbol for Goldman Sachs. And then if you're on Thinkorswim, you can select the strategy in this box right here. So for this one, it's going to be a single. We're going to be looking at options contracts that expire October 2021. And we're going to be looking at this strike price right here, the 350. And down here, I already have the trade set up and ready to go. So we are simply looking to buy one October 350 call. And the 350 call option gives the investor the right to buy 100 Goldman Sachs shares at 350 up until the expiration date. With this trade, you only need to invest around $3,100 rather than $37,000 for buying 100 shares outright. If Goldman Sachs goes to $0, then the most you can lose on the trade is the $3,100 that you invested, and you still maintain similar exposure to gains as you would if you bought the stock outright. There's always a risk with trading on leverage. If the stock drops below 350 at expiration, the investor will lose 100% of the investment, or roughly $3,100. Savvy traders might consider reducing the cost of the long call by selling an out-of-the-money call. This reduces the cost of the option and also reduces the gain potential. So for example, the October 410 strike call can be sold for around $5.90, reducing the cost of the long call by around $590, but it would cap gains above 410. This is also known as a bull call spread, and for more on those, you can check out our videos on that specific trading strategy. One more thing, there is an earnings risk with this trade. Goldman Sachs is set to report earnings next week on July 13th before the market opens. And there you have it, your option trade of the week. Remember that options are risky and investors can lose 100% or more of their investments. So make sure that you practice with a virtual trading account before risking any real money, especially if this is new to you. And check out investors.com/options for more option trading tips.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.